Good evening. This is Ken Long from Tortoise Capital with a review of the weekly, daily, and charts of interest reports for May 21st, 2011. Starting with the strategy report, we have a market that is in bullish normal conditions. On an annual basis using weekly RSI 14, we're at 62 out of 100, so slightly above average, but still neutral. On a 10-day look back using the 10-day NDX, we're at 37 out of 100, so at the low end of normal, just above oversold conditions. The percent stretch above the 200-day moving average is almost 8%. That's coded bullish, but in color code white, meaning it's been an awful lot stronger in the last 6 months. We're 8% above the 200-day moving average. That's been about a 6% pullback from recent highs. Slope of the 50-day moving average at 0.18%, although it's positive, is coded red and bearish because that's about as weak as it has been in the last 180 days. ADX 14 is at 10.6, which is weekly trending or basically sideways. It's dropped below the key level of 15, and so we have a choppy sideways market with little to no follow through day over day. That leads us to believe that taking profits intraday is advantageous. There's little to no advantage in holding out for overnight momentum. ATR percentage at 1.16% is higher than last week. At the high end of normal. So for the past 2 weeks, volatility has been on the increase. This favors intraday trading because the daily ranges are larger and there's been little to no follow through. Monthly rebalancing doesn't change until about 1 June, and quarterly rebalancing on 1 July. Equities have been sideways and weak all past week with a slight increase in volatility. In ETF2, we sold EWG and EWY by rule. We're at 4 positions and 40% exposed. All we do this week is adjust 1 stop. Theoretical exposure of the model is at 30%. The model portfolio is at 40% with no additional actions. This is the market health check. The blue vertical lines are 10-day look-back periods, 10, 20, and 30 days we look at primarily. The solid purple horizontal line is the most recent swing high at about 137. The dotted purple line was the previous swing high at 134. What was once resistance now may be support. You can see price clustering around the key level of 134. The horizontal red line is a 5% pullback from the recent swing high. Price in between the purple and the red line is in the range of random noise. If it were to fall below that, then we'd start thinking about this being a correction in a normal bull market. Price is right at the 10-day moving average, which is the green line, and it's better than the 50-day moving average, but it's getting closer, and this is a sideways market that's going to make a break in one direction or the other as price converges in on itself. We're still 8% above the 200-day moving average, which is at 123 and just barely off the chart in front of you. On a short-term look back, Williams percent R is right in the middle range. Most recently came out of oversold with little to no follow-through, no directionality or directional preference. On an annual basis, Williams percent R still comfortably overbought. ADX has drifted down from as high as 25 2 months ago down to just above 10, and that is a working definition of a sideways non-trending market. You can see plus DI and minus DI are equal to each other here, so no directional bias whatsoever. This favors short-term channel trading on shorter-term time frames. Looking at the 10 regional indexes in ETF2, 7 out of the 10 are negative on a 5-week rate of return, which gets us to 30% exposure, 70% cash in the theoretical model. SPY at 60 is better than EFA at 48, so slightly favoring the U.S. over the globals. Inside the U.S., the strongest sector is U.S. mid-caps at 65, followed by large caps at 60, technology at 59, and trailing are U.S. mid-caps, small caps, excuse me. Strongest two sectors are U.S. mid-caps and large, MDY and SPY. The two weakest are ILF Latin America and EWJ Japan. Latin America and emerging markets are noticeably weak. You can see in the red 34 and 30, noticeably weak, and are at the bottom of the ETF database. In the world market model, you see the U.S. is generally above average with the exception of U.S. small cap value and balanced. Asia, less Japan, and most of the Asian countries are below average. Malaysia and Singapore are the exception, being above average at 66 and 62 respectively. Latin America and emerging markets lagging the world. Brazil near the bottom of the barrel. The commodity-rich economies of Canada, Mexico, and Brazil accounting for that weakness. Commodities continue to lag with oil and silver exceptionally weak. Blended commodities just about the midpoint. Gold has retained its value greater than silver in the recent volatile trading. All across Europe there is general weakness with the exception of Switzerland and Sweden. Exceptional weakness Netherlands, Austria, and Spain. The U.S. business sectors, the defensive sectors of staples, utilities, and healthcare are exceptionally strong, and we would not be surprised to see that continue for another week. That's echoed in the globals with strength in staples and healthcare. Only global utilities are differentiating from U.S. utilities in that regard. Financial sector weak across the board for about the sixth week in a row. Materials and energy still suffering from the sell-off in commodities. The 100 by 200 crossover system examines the intermediate to longer term technical indicators of price. You can see, generally speaking, that the U.S. looks healthier than the globals. Nothing is on the short side right here, but most of the internationals and a number of the commodities are looking weak. In the U.S., only technology and basic materials and finances are weak, and that's confirmed by what we saw in the world market model. Taking a look at the top ETFs in the ETF2 database, it's dominated again for the third week by healthcare, biotechs, food and beverages, retailers, pharmaceuticals. The first country sector that we see is Switzerland. Shout out to Swen. U.S. retail continuing its strength. Mid-caps, Russell mid-caps, IWR, again being the strongest of the 10 ETF2 sectors. That is close to the top as well. So little to no change week over week among the leaders in the ETF2 database. Taking a look at ETF liquidity, the top 30 ETFs by average daily dollar volume. Little to no change here. Silver and gold remain at number 5 and 6 respectively in terms of average daily dollar volume. No other changes noteworthy on the chart. Those that are highlighted in green are those that are exceptionally volatile intraday and make excellent trading candidates for short-term trading, which is particularly useful during a sideways choppy market with increasing volatility. Silver remains above 6%, the oil above 4%, VIX is down to 4.77% daily ATR percentage. That's a quick review of the weekly report. I think the key points to take out of this once again are sideways market, no directionality, strength in healthcare, the U.S. and mid-caps, and with weakness in Brazil and Latin America, and commodities. If you're looking for one-day bounces off of extreme oversold conditions, those would be on my short list as well. That completes the weekly report review. Keep your powder dry and your risk measured.